Section 3, Client Investment Recommendations and Strategies. In making recommendations for your client, it will be important for you to determine what type of client are you dealing with. Is it an individual? Is it a joint account? Or is your client a business? So the test would like you to know a little bit about the various different types of business entities that exist. In some ways, this topic appearing on your exam baffles me, because I really don't think that you're going to have a client come to you for advice as far as thinking of starting a new business. What kind of business organization do you think I should have? But really, that's where there's this emphasis on the exam these days. Do you understand the different types of businesses? Do you understand what they're good for? Do you know what are the simplest ones? What ones are flow-through tax entities? There is this emphasis on this area of the exam. So I'll have to teach you some of this. But in the real world, I wouldn't provide legal advice to your clients unless you were a lawyer and had the ability to actually give that legal advice. So always make sure that within your team of people you have a great accountant that you can refer clients to, as well as a great lawyer to help them incorporate their business or draft their articles of organization for their LLC, or understand all of the consequences that you would have as a flow-through tax entity. So I will teach you the basics as far as the different types of business organizations. So we have business organizations that are taxed at the business level and we have types of business organizations that are what we call flow-through tax entities. And to be honest, most types of business organizations fall in this latter category as flow-through tax entities. So taxed at the corporate level would be C corporations, so a C corporation, most publicly traded companies are C corporations. They can have an unlimited number of shareholders. They are limited only by their corporate charter. LLCs, taxed as corporations. We'll talk more about the LLC. Taxed as a corporation. And nonprofit corporations. So these would be the three business entities that are taxed at the business level. Everything else is a flow-through tax entity where the taxes are payable at the shareholder level. So a sole proprietorship. This is what we call a Schedule C on your Form 1040. Sole proprietorships are taxed at the owner's level. Sole proprietorships can only have one owner. S corporations are also taxed at the shareholder level. So it's a flow-through tax entity. Partnerships. So the flow-through tax entity, the business partners in the partnership, they get what's called a Schedule K1 that shows their percentage of the income or their percentage of the loss, as the case may be. So partnerships are flow-through tax entities, as are LLCs that are taxed either as a sole proprietorship or as a partnership. LLCs. So LLCs we'll talk more about as we go along. So tax at the business level or flow through entities. I expect you will have at least a question on this topic. So the business will have to file paperwork with the Secretary of State in which their principal place of business is. what paperwork they end up having to file depends upon what type of business they have determined that they would like to establish. It's important to note that the LLC is a type of a business organization that is recognized at the state level but it's not recognized by the IRS. So if you file articles of organization to become an LLC, there's another piece of paper that you are also required to file with the IRS to determine how does this business intend to pay its taxes. So an LLC offers the liability shield of a corporation with the flow-through tax consequences of, let's say, a partnership or a sole proprietorship. So the business itself has to file paperwork. It's called Form 8832 with the IRS. It's the entity classification election to let the IRS know how they intend to pay their taxes. So Form 8832 is required to be filed by the LLC. There is no box when you do a tax return with the IRS at the federal level for an LLC. So you're either going to choose to be taxed as what we call a sole proprietorship. So this is called a sole member LLC. So this is a flow-through tax entity. It flows through to Schedule C on your 1040. The LLC could choose to be taxed as an S corporation or as a C corporation at the federal level as well. So they have to make an election on this form that is filed with the IRS, S corp or C corporation. So the C corporation would subject the business to taxes being owed at the corporate level. So remember, the LLC is only a state-recognized business organization. Form 8832 must also be filed with the IRS to notify them of how the LLC intends to be taxed. You will have questions sometimes on the forms and what forms go with what business organization. So we already mentioned the sole proprietor. Where do they pay their taxes? Form 1040, Schedule C. Schedule C. That's where the business income and expenses are listed. A corporation, it's Form 1120. A corporation's tax form. A partnership is 1065. An S corporation fills out 1120S. Now, you're not doing this. Your client's accountant is doing this for you, right? You're not helping them do this. A trust is a 1041. So if you have a client that's a trust, what form are the taxes paid for a trust? On Form 1041, test question. Nonprofit organizations, they have Form 990. You have to know the 1041 for trusts. It's also the form for estates as well. I would know the Schedule C for the sole proprietorship of your 1040. Those are the ones for sure you must know. So why might someone want to establish a sole proprietorship? Why might they? It's the easiest of all of the business entities to establish. It's not a corporation. It doesn't have limited liability status. So that the individual represents the business legally and fully. So there is some risk in establishing a sole proprietorship that you expose your personal assets to any risks that you have as far as the business goes. Common proprietorship structures include part-time businesses, direct sellers, new startups, contractors, and consultants. So some of the advantages of establishing a sole proprietorship. Quicker tax preparation. As we said, that when you're a sole proprietor, you pay your taxes on your 1040. It is a flow-through tax entity. The business itself has its own Schedule C. So if you had more than one sole proprietorship, you could potentially have more than one Schedule C on your 1040. Your individual and business income are considered the same, and self-employed tax implications will apply. There's low startup costs to start a sole proprietorship. There's no special paperwork that needs to be filed to start up your own sole proprietorship. If you were looking to being able to raise capital for your business, I would not establish a sole proprietorship. Limited capital is a reality for a sole proprietorship. So generally speaking, these are businesses that are funded with the retirement account of the owner or maybe the credit cards of the owner. It's very hard to go and get a business loan for your sole proprietorship from a bank. But it has low startup costs because there's no special fees for a lawyer to fill out for you. Another benefit is the ease of money handling. There's no payroll setup required to pay yourself as a sole proprietor, although it is recommended that you establish a separate business account so that you're not commingling your personal assets with your business. Disadvantages of the sole proprietorship. As that business owner, as that one person, you have unlimited liability. You are legally responsible for all debts against the business, thereby putting your personal assets as well as the business assets at risk. It's harder to raise funds when you have a sole proprietorship. And it may be harder to attract good employees if all you are is a sole proprietorship. So a little background on the business entity of sole proprietorships. One question potentially on the test. A C corporation. It's an incorporated business. Every form of business besides the sole proprietorship is considered a separate entity from the owner, allowing for some measure of legal and financial protection for the shareholders. Publicly traded companies are C corporations. They are subject to double taxation in that the business pays the IRS, and then out of the after-tax income of the business, they pay a dividend to the shareholders, and then the shareholders owe taxes on the dividend as well. So double taxation for a C corporation. A C corporation protects the shareholders. As a shareholder, you have limited liability. The most that you can lose is however much you paid for your share. Corporations have full discretion over the amount of profits that they can distribute or retain. Corporations are presumed to be for-profit entities, and as such, they can have an unlimited number of years with losses. Not all business entities can continue to function with losses, but a corporation can. A corporation, like I'd said, is its own legal entity. It can exist into perpetuity. It can be taxed, it can be sued, and it can enter into contractual agreements. The corporation must be owned by at least one shareholder. The shareholders elect a board of directors to oversee the major policies and decisions of the corporation. The corporation has its own lifespan, and it does not dissolve when ownership changes. Advantages of a corporation include your shareholders have limited liability for the corporation's debts or judgments against the corporation. Generally, shareholders can only be held accountable for their investment in stock of the company, although an officer of the corporation can be held personally liable for their actions. Corporations have the ability to raise additional capital through the sale of stock. A corporation may deduct the cost of benefits it provides to officers and employees. Corporations can elect S corporation status if certain requirements are met. An S corporation is taxed like a partnership, thus not subject to double taxation. So it depends upon the situation if they would like to be an S corporation or not. S corporations are limited to only being able to have 100 shareholders. So generally, publicly traded companies will be C corporations. Disadvantages of forming a corporation. Articles of incorporation must be drafted and filed with the Secretary of State, so that the process of incorporation requires more time and money than some of the other forms of business organization. Corporations are monitored by federal, state, and some local agencies, and as a result, may have more paperwork to comply with regulations. Incorporating may result in higher overall taxes. I mentioned that the dividends are paid after taxes. So out of after-tax income, then the dividend paid to the shareholder is taxable, thus double taxation. Partnerships are unincorporated businesses. Like a corporation, a partnership is a separate entity from the shareholders. Unlike corporations, partnerships must have one general partner who assumes unlimited liability for the business. Partnerships must have at least 2 shareholders. So in a general partnership, you are held you have to have at minimum 2 partners. In a general partnership, you're held what's called joint and severally liable for the business decisions that your business partner has made, even if you had no idea what they have done. So a general partnership is risky. A limited partnership, the general partner has unlimited liability, but the limited partnerships have limited liability. The partnership is a flow-through tax entity. It distributes its profits or losses to the members of the partnership. That form that distributes the profits or losses is called Form K-1. Partnerships distribute all profits and losses to their shareholders without regard for any profits retained by the business for cash flow purposes. Like proprietorships, the law does not distinguish between the business and its owners when you have a partnership. The partners should have a legal agreement that sets forth how decisions will be made, how profits will be shared, how disputes will be resolved, how future partners will be admitted to the partnership. What needs to happen is a subscription agreement needs to be signed and filed with the Secretary of State. What steps will be taken to dissolve the partnership when needed. These all need to be spelled out in what is called the partnership agreement. It also must be decided up front how much money and time each person in the partnership will be asked to contribute. Some advantages to having a partnership. They're fairly easy to establish, although time should be put into developing a thoroughly thought out partnership agreement. If you have more than one owner, the ability to raise funds is increased. It's an advantage that it's a flow-through tax entity with any taxes owed being paid on the partner's personal tax returns. You might be able to attract some great employees by allowing them to potentially become a partner themselves later on in the business. A partnership usually will benefit from partners who have complementary skills. Disadvantages of a partnership. If it's a general partnership, like I said, partners are held joint and severally liable for the actions of the other partners. It's a disadvantage that you have to share the profits with the other people. because it's not just you. You have to agree when you make decisions, thus disagreements can occur. Some employee benefits may not be deductible from business income on tax returns. That would be a disadvantage. It is also true that unlike a corporation which can have an unlimited life, a partnership has a limited lifespan. It may end upon the withdrawal or death of a partner. General partnerships would be the riskier of the two, where there's two or more general partners, joint and severally liable for each other. Both have unlimited liability. I would assume if there was two partners that they would equally own the partnership unless the partnership agreement stated otherwise. A limited partnership would be safer as far as a limited partnership. The limited partner has limited liability. The general partner still has unlimited liability. Forming a limited partnership is more complicated than simply forming a general partnership. So there's a certificate of limited partnership. That's the title of the paperwork that a lawyer would want to draft for you. You would want a lawyer to draft for your client, that is filed with the Secretary of State. If the certificate of limited partnership is not filed with the state, then it is assumed that it is a general partnership. General partnerships can be formed simply by an oral agreement between two or more persons, but it's advantageous to draw it up in writing by a lawyer. Thus, you will incur legal fees to draft up the partnership agreement. So legal fees would be higher to set up a partnership than they would be as far as establishing a sole proprietorship, but probably not quite as expensive as setting up a corporation. It's important that the partnership agreement discuss these following items: type of business, amount of equity invested by each partner, division of profit or loss, partner's compensation, distribution of assets on dissolution. So an investment advisor may be hired to distribute the partnership assets. How would the investment advisor know how to distribute those assets? They would need to read the partnership agreement. How long does the partnership last for? The duration of the partnership. Provisions for changes or dissolving the partnership. A dispute settlement clause. Restrictions of authority and expenditures, and settlement in the case of death or incapacitation. So all of those things would be described in the partnership agreement. The LLC, very popular type of business organization. Like I said already, it is a state-recognized business entity, but the IRS does not recognize it. So the Form 8832 had to be filed to tell the IRS what kind of a business entity does this LLC intend to be taxed as. The LLC provides the limited liability features of a corporation with the tax efficiencies and operational flexibility of a partnership. Formation is more complex and formal than that of a general partnership. The LLC is owned by members. So you can have a sole member LLC, which is taxed as a sole proprietorship, or you can have two or more members. The duration of the LLC is usually determined when the organization papers are filed. So the paperwork that's filed with the Secretary of State is called Articles of Organization. The time limit on an LLC can be continued if desired by a vote of the members at the time of the expiration. An LLC, in order to avoid being taxed like a corporation, thus subject to double taxation, the LLC must not have more than two of the four characteristics that define a corporation. So there are four characteristics that define a corporation: limited liability to the extent of assets, continuity of life, centralization of management, and free transferability of ownership interests. So an LLC is allowed to have at most two of those four. Very popular type of a business organization. Subchapter S Corporation. They have features similar to that of a partnership. S corporations must have at least one shareholder and cannot have more than 100 shareholders. If any shareholder provides services to the business, the S Corp must pay that shareholder a reasonable salary. The IRS likes that rule. The salary is a separate payment from distribution of profits or losses. Subchapter S Corporation is really just a tax election only. This election enables the shareholder to treat the earnings and profits as distributions and have them pass through directly to their personal tax return. The catch here, this is what the IRS will look for, is that the shareholder, if working for the company, which generally the shareholder does work for the company, if there is a profit, must pay him or herself wages, and the wages must meet the standards of reasonable compensation to make sure that we're having the right amount of taxes paid on the wages that are attributable to the owner of the business versus just allowing all the profits of the business to flow through at the business level will result in less taxes having to be paid. So the IRS is really on top of looking for making sure that that person is paid a reasonable compensation. So what is considered reasonable, because that's a fairly lawyerly term, the definition varies by geographical region as well as by occupation, but the basic rule is that you are required to pay yourself what you would have to pay someone else to do your job, as long as there is enough profit. If you don't do this, the IRS can reclassify all of the earnings and profits as wages, and you will be liable for all of the payroll taxes on the total amount. So it's a red flag that the IRS looks for, an S corporation that reports zero officer compensation. It's an audit flag. Remember, sole proprietors, S corporations, and partnerships are taxed at the shareholder level. Corporations are taxed at the corporate level. So C corporations are double taxed. In choosing a type of business organization, maybe it's for yourself, or maybe you're helping your client determine what is best for them. Some of the decision factors to think about include how profitable do you expect the business to be? How much of those profits do you want distributed to you versus reinvesting the profits back into the business? So there's situational based questions that I expect that you will have on the exam. So this will give you some guidance in this area. Generally speaking, profitable businesses would be best as C corporations. So this is a regular corporation that files Form 1120. Tax laws are going to change over time, but currently the lowest tax bracket for a C corporation is the 15% bracket that goes from income of $0 to $50,000. It may be possible to manage your small business finances so that your corporation will never pay more than 15% in taxes. So the tax percentages, I'm not expecting you to have to know those on the test because those constantly change. Within the course will be a current year's tax fact sheet, if you will. It has contribution limits for qualified plans as well as any important tax rules that I would need you to know for the exam. But generally speaking, profitable businesses would like to be a C corporation. For other forms of business, partnerships, S corps, LLCs, sole proprietorships, tax is not levied at the corporate level. Instead, all profits are fully distributed to the shareholders and reported and taxed on each shareholder's 1040. So these are flow-through tax entities. On a profitable business, this will increase each shareholder's taxable income and possibly move them into a higher tax bracket. If a business is losing money, or if you expect to start a business and it's going to maybe lose money in the beginning. Losses are retained by a C corporation and used to offset next year's income. In other forms of businesses, the losses pass through to the shareholders, or the loss reduces the shareholders' total income. Losses on a pass-through entity provide a significant tax break in the year the loss occurs. For example, if your sole proprietorship had a loss in the first year, the loss flows through to your personal tax return, thereby reducing the amount of income taxes that you will owe. However, if you're a limited partner in a limited partnership and a loss flows through to you, your passive loss can only be written off against passive income. So you'd have to have one partnership that was doing poorly and one that was doing well to be able to use that passive loss that year. When you have a regular C corporation, losses provide a significant tax break in the future because you're allowed to carry forward those losses into the future years and offset future income. Generally speaking, business owners prefer to operate an unprofitable business as an S corp, partnership, LLC, or sole proprietor. Those are the flow-through tax entities. And generally speaking, business owners prefer to operate a profitable business as a regular C corporation, an LLC, taxed as a C corporation, or a partnership. C corporations are the only business that can split profits between retained earnings and dividends. We talked about that when we did fundamental analysis and we looked at the income statement for a publicly traded company. We saw that the undistributed profits of the business, the net income, flow through to the balance sheet and become a component of retained earnings. We know that the corporation has the ability to pay dividends before they have retained earnings, before they keep the net income at the end, and the dividends paid to the shareholders are taxable. S corporations and partnerships must report all profits as a distribution, even if the business has retained some of the cash for next year's operating expenses. The ability to choose when and how much you are taxed by controlling when and how much money is distributed is a crucial tax advantage for the C corporation. This means that the C corporation has more flexibility to pick its tax rate than there is with the other forms of businesses. S corps, partnerships, and sole proprietorships, the Schedule C businesses, are much easier, however, to operate. Business considerations play a crucial role in deciding which form of organization is best for an enterprise. It's important to balance the tax benefits of incorporating with various business and legal needs. If a new venture has a pressing need to raise capital from outside investors, they don't want to have a sole proprietorship. So what might they want to establish? A C corporation is the easiest way to satisfy the demand that a company would have to raise capital. C corporations can have an unlimited number of shareholders. They can have different classes of stock, and they do not need to be dissolved if a shareholder leaves. Partnerships, by contrast, must be dissolved whenever more than 50% of the partnership interest changes hands. Raising capital in a partnership is consequently more involved. S corporations are limited to only 100 shareholders. And a Schedule C sole proprietorship is limited to only one owner. So sole proprietors have the hardest time raising capital. The only place they can really go is to a bank. They have no ability to have outside investors. Another point to consider is the ability to transfer ownership. At some point, the business might need to transfer the ownership of the business to another party. You might be choosing to sell your business, transfer some of the ownership in your business to your children, or you might just want to be bringing on a new business partner. With C corporations and S corporations, you can add new shareholders and transfer shares with relative ease. So if that was one of the needs for your client, to be able to transfer ownership easily, C corporations and S corporations would be the easiest. To transfer a significant portion of a partnership, it may be required that the partnership terminate entirely and that a new partnership be formed. It's important to note that ownership of a sole proprietorship cannot be transferred to someone else. As a sole proprietor, if you want out of your business, you don't sell the business itself. You're only able to sell the assets and liabilities of the business to someone else. But the buyer would have to form their own business. Separation of ownership and management is another key factor to consider in establishing a business. In C corporations, limited liability companies, and limited partnerships, shareholders are separate from management. That's in a C corporation, an LLC, and a limited partnership. Shareholders do not take on any management responsibilities, and managers do not shoulder any ownership responsibilities. This separation is crucial for keeping liabilities from bad management decisions from depleting the shareholders' personal assets. By contrast, general partners in a partnership, shareholders in an S corporation, and sole proprietors are not separate from management. So as a sole proprietor, you actively manage your own business. As a shareholder in an S corporation, you're involved in management. The general partner of a partnership is actively managing it. On a daily basis, they're actively managing the business. Limited liability protection, depending upon what type of business entity has been formed, there may or there may not be liability protection. So it is a major legal consideration in choosing a form of business. Limited liability means that the owners of the business are only liable for the capital they have invested. Let's say that my company is sued for $5 million, but as a shareholder, I have invested only $10,000. With limited liability, the most I can lose is the $10,000 that I have personally invested. My personal assets, such as my house, my car, my bank account, cannot be touched. Limited liability is available for C corporations, S corporations, LLCs, and limited partners in a limited partnership or limited liability partnership. General partners in a partnership and sole proprietors have unlimited liability, so that is important. Creditors and lawsuits can go after the owner's personal assets, their house, their car, their bank accounts. As such, partnerships and sole proprietors are good only for a business that has small risk for liability exposure. For example, if you formed a partnership to invest in the stock market, or you're a freelance writer, or you're an artist, you have low risk for liability. So if you wanted to have a sole proprietorship or a partnership for either of those, that would probably be okay. Anytime you are at risk for being sued for accidents, bad decisions, or property damage, you would want to consider a business organization that has limited liability protection. You already know what is the simplest type of business to establish. That is the sole proprietorship. You don't actually need to do anything at all until you file your taxes and you first begin to report your income on the Schedule C of Form 1040. The sole proprietorship is also the easiest type of business to stop being. You just shut it down. There's no special forms to file. All of the other forms of organization that I have discussed require filing various papers with your state government and with the IRS to begin them and to end them. I already told you to start a corporation. There's articles of incorporations. There's also bylaws that must be filed with the state government. The business will need to obtain a tax ID number from the IRS. And then you need that ID to set up your business bank account. It is possible that you could incorporate a business yourself, or you can hire a professional incorporation service. There are fees involved in incorporating. It's always good to talk to an attorney. There's filing fees for filing the paperwork. So in addition to the attorney's fees for drafting the proper paperwork, you have fees associated with filing. That's true for articles of incorporation or articles of organization for an LLC or a partnership agreement for a limited partnership. So all of the fees are going to vary by state. You'd want to check with the Secretary of State in the state in which the business's primary business is. So part of your job will be to give some guidance in this area. I will expect you will have a few questions on the various different types of business entities and the pros and cons of each.